Bond yields are starting to spike after being relatively low for such a long period of time. Joining me here to discuss this and more about the fixed income markets around the world, Tony Crescenzi from PIMCO, a fixed income strategist and portfolio manager there. Tony, thanks for joining us.
Thanks for having me.
So the first question I think everyone is wondering is the bull run, that many people talk about being a decades-long bull run in bonds finally coming to an end. Is this a bubble that's in the process of bursting?
The journey is largely over simply because there isn't a lot of room between here and zero. Bond investors more than ever have to start focusing on what we would call our other sources of value, which is to say that you can't depend upon price gains alone, because when yields fall, prices rise, of course, in bonds. What you have to depend upon is our other things, such as looking at corporate credits, company bonds, or bonds overseas. So these are the new sources of value that will take people beyond the ending of the 30-year journey on rates.
Do you have any sort of guess at all or prediction in terms of how high rates on the 10-year could go? I mean, I'm assuming you don't expect them to get back to that 16% level, let alone any double-digit number anytime soon.
What we see for 2011 is the 10-year Treasury note yielding between 3 and 4%. A move much higher than 4% would require two things: either a rise in the federal funds rate or a rise in the inflation rate. So we don't see either the Federal Reserve raising interest rates or the inflation rate accelerating enough to push out long-term interest rates materially.
You discussed the need for investors in the fixed income markets to look outside of treasuries, look overseas in particular. Where do you see attractive opportunities? I would imagine that the Eurozone might not necessarily be a place for people to go, given some of the big problems with the quote-unquote pigs nations.
That's correct. Well, we have to think about, in terms of the bond markets, that it's a $90 trillion global supermarket. And so think about aisle 2. That's where treasuries are. There's a breakage or a spillage in aisle 2, so perhaps aisle 2 is not the aisle to go down. Europe is also perhaps some breakage there with the problems in the so-called periphery and other problems with the debt levels there. So Europe is not a place to look for other sources of value in this $90 trillion global supermarket. The places that one should look at include Latin America and Asia. So, for example, we're interested in Brazilian bonds. These bonds there, many yield double digits with an inflation rate there of about 5%. And many other countries in Latin America, including Mexico, we would say is another place we would consider. And again, Asia. What the dynamic there in these countries is that they're growing strongly and they have very low levels of debt, or in many cases, high levels of reserves, which is basically money in the bank, money that could be used to pay back bond investors. And what a bond investor cares most about is getting his or her money back. And that seems most likely in countries outside of the developed world.
A lot of people are wondering, given the crisis, the fiscal problems that many states and local governments in the United States have, we may have muni bonds as past their expiration dates, spoiled, so to speak. Do you think that the generalization about the muni market right now is fair, or do people need to be more discerning and not, lump everything together because of problems in, say, California or Illinois, to think of, two of the more troublesome states right now?
There is a bit of throw out the baby with the bathwater situation going on now in the municipal bond market, because many municipal credits are fairly good credits, and what investors should do is try to weed them out. There will be problems at the very local level, not major ones, we don't think, nationwide. We don't see any big problems at the state level. What an investor should do to shield his or herself is look at revenue bonds instead of GO or general obligation bonds. Find revenue bonds where there are dedicated revenues for essential purposes like water and sewer and transportation and energy that will go back to paying back the bond investor. So what I'm trying to say, even if you don't remember those details, is that a municipal bond investor now has to be very choosy, but there are opportunities coming up that have surfaced because the investors are basically throwing them all out to an extent and cheapening them up, if you will. They're on sale, many of these municipals that are fairly good credits.